Everyone knows that silver is the poor man's gold, but the question is it going to make us rich? We've seen the volatility in the markets recently, and there are arguments for both sides. Today, I will start off by covering the latest developments in US inflation and silver prices, before moving to my analysis of silver and my top silver stock picks. If you want to learn more, smash the like button to help out the channel and keep watching. So, the drop last week happened because of two things. One, inflation was not as hot as it was expected and actually fell month on month from 0.8% to 0.6%. Two, the Fed told us that interest rate hikes are coming sooner than expected, which resulted in a stronger dollar. This is maybe an oversimplification, but those were the two main drivers behind higher silver prices, and inflation means that the dollar will be devalued, and since silver is valued in dollars, it would become more expensive during high inflation, so a lower inflation means that we're seeing a drop in silver prices. Also, interest rate hikes are meant to contain inflation and also make bonds and cash more competitive to silver, so that's again a bearish sign for silver prices. This applies to all commodities really, not just silver, and we also saw the drop in gold, platinum, palladium, wheat, commodities all across the board really. So, it is looking like inflation is transitory and it could be contained by the Fed. That's definitely the message that the markets are sending. However, if you are suspicious and perhaps a bit paranoid like me, this is a great opportunity to buy the dip in silver prices. I mean, the Fed raised their own inflation expectations for this year by a full percentage, so we can tell that inflation will persist for longer than initially expected. There is more to it, but for now, I will just say that it is good to keep an eye on the 5, 10 and 30-year US bond yields as a gauge of the market's inflation expectations. So, in the short term, it looks like we could be entering a sideways or slightly bearish market for silver. But is the long-term bullish case affected? Well, what is the main driver behind silver? A less valuable dollar is definitely a driver, but silver is also in high industrial demand. Silver is the best conductor of energy and it is therefore used in a lot of electric components. It is not as cheap as copper, which is why copper is usually preferred, but silver will still play an important role alongside copper in the electrification of economies all around the world. Even though a lot of investors see silver as similar to gold, meaning an investment and a store of value, more than half of the annual demand for silver over the last 5 years has actually been industrial use compared to the 10 or 15% for gold. Silver is used in solar panels, batteries, alloys, dentistry, semiconductors, touchscreens, electric vehicles, even 5G, and its importance and widespread use will only go up. Again, it may be wise to pair silver with copper as a hedge, but both metals seem to be in rising demand. Rising demand usually translates into rising prices, although such a rise in industrial demand will likely happen gradually. On the other hand, we also have the monetary demand, and it can drive prices up, especially if paired with a supply shortage. Now, do we have a supply shortage for silver? The answer? Definitely. Some of the UK bullion banks that deal in silver are out of stock. US bullion banks are selling silver at high premium, in some cases ranging up to 75% over the spot price. My personal bet is that this supply shortage of coins, especially North American ones, is driven by Wall Street Silver on Reddit, who are stockpiling silver at an astonishing rate. However, that is just on the monetary side. On the industrial side, silver demand is increasing and is expected to reach 1.15 billion ounces by 2025, with a supply of only 1.06 billion ounces, so there is a possible incoming shortage and it's coming fast. 2020 saw a dip in industrial, jewelry and silverware demand, but that is coming back strong along with the surge in demand for silver as a physical investment. Now, is silver cheap? Well, it was cheap in March, when the gold to silver ratio, meaning the ounces of silver required to match the price of an ounce of gold, topped at 127. However, it ended last week at 67.5, almost half of what it was a year and several months ago, so we're no longer at a historically cheap period for silver, at least when compared to gold. However, we're still far from the 2011 silver price highs of $47, and we have seen a consolidation in silver prices over the last 10 or so months, so it could go either way, depending on what inflation we see and how the Federal Reserve and the markets react. the increased demand for physical silver may ensure a relatively stable price, but only time can tell that. Now, the good news is that even though silver has remained stable since the start of the year, a lot of silver stocks have actually fallen, meaning that there is a discrepancy between silver prices and silver miner prices. Typically, miners fall harder in a bearish market and they rise higher during a bullish market, so this looks like a perfect opportunity to buy some miner stocks. The ones who have fallen the hardest since the start of the year are Fortuna Silver Mines, Fresnillo, Pan American Silvercorp and Silvercorp Metals, while Wheaton Precious Metals, First Majestic Silvercorp and Glencore have actually outperformed silver by a lot. Out of these, Fresnillo is the biggest producer of silver in the world, followed by KGHM, Glencore and Pan American Silver. Interestingly enough, Southern Copper, which is one of the largest copper producers in the world right now, is also ranked 7th in terms of production of silver, so it's also a good pick, although I have covered it in another video which you can check at the top right. Wheaton Precious Metals is the only streaming company here, meaning that they don't actually mine anything, they only buy and sell the metal to make a profit, while all of the other ones engage in exploration, development, mining and refining. Glencore is probably the biggest and most diversified, producing everything from copper and cobalt to silver and zinc, whereas miners like Fresnillo, Pan American Silver, Fortuna and First Majestic are focused on either silver and gold or just silver. How are these companies valued though? Well, First Majestic and Wheaton have the highest valuation. First Majestic is a growth silver company with a good story of trying to become the #1 silver miner, so is getting a much higher valuation than the rest, given that there are not a lot of growth players in that field. They've got a PE of 61.8 and a forward PE of 231, which is astonishingly high. A bit too high for my taste really. Wheaton also has a high PE of 34.2, but its forward PE is only 27.8, which shows a decent growth of 23%. Then Fresnillo, Fortuna, Pan American Silver and Silvercorp all have a similar valuation of between 21 and 24 PE. However, the ones that show the best growth are Pan American Silver and Fresnillo, with a forward PE of 12.5 for Pan American and 14.5 for Fresnillo. Glencore has been unprofitable in the last 12 months, but it does have a low forward PE of only 6.5, which is good to see. However, let's look at the free cash flow, which is probably a more important metric. I'm not surprised to see that Wheaton is at the top of the list with an almost 42% free cash flow margin because of its business model, followed by Fresnillo with 20%, Pan American with 18.4% and Silvercorp with 16.6%. Glencore has a tiny 2.1%, while Fortuna and First Majestic have a negative 9% for Fortuna and a negative 11.8% for First Majestic. First Majestic is the fast grower here, so a negative free cash flow could mean that they're spending a lot of money on expansion, but that still needs to be monitored, while Fortuna is not really that outspoken about its expansion plans, so its negative free cash flow is actually worrying and probably a red flag. In terms of health, Pan American, Silvercorp and Wheaton have no long-term debt, while Fortuna, First Majestic and Fresnillo have between 20 and 35% debt-to-equity ratio, while Glencore has a massive 105% debt-to-equity ratio, which may explain their lower valuation, especially when combined with the low free cash flow. Overall, all of them look healthy, apart from Glencore, although they are massive and mining is extremely capital intensive, which could explain it, but still, the large debt is a red flag to me, especially when you compare it to the rest of the companies. Then, another important factor when looking at miners are dividends, even though they tend to fluctuate a lot and usually depend on metal prices. The highest dividend is paid by Glencore at 2.9%, followed by Fresnillo with 2.3%, Wheaton with 1.3% and Pan American Silver with 1%. Silvercorp are paying a tiny dividend at 0.4%, First Majestic is paying an even tinier 0.1%, and I don't even know why they're bothering with paying a dividend in the first place when they're allegedly focusing on growth. I would rather that they invest the money, not return them to shareholders. Finally, Fortuna does not pay a dividend at all, so it is definitely not one to include in your dividend portfolio. Another important dividend metric is the payout ratio, which essentially tells us whether the company can afford to pay dividends, and essentially shows us the dividend as a percentage of net earnings. The higher it is, the less affordable and the less sustainable it is. So we can immediately see another red flag with Glencore because they're paying a dividend while not turning a profit, which is again worrying. Fresnillo has the highest payout ratio with 51%, which is within reason, followed by Wheaton with 35% and Pan American with 20%. Finally, Silvercorp has a payout ratio of only 9%, first Majestic has a tiny 1%, and Fortuna does not have one because they're not paying any dividends. Alright, so what's my verdict? My opinion as a non-professional newbie investor. Don't forget to do your own research on that, but the way I see it is that Fresnillo and Pan American Silver are the best choice. They've got decent free cash flow, they have an okay dividend, they're valued well, they are exposed to both silver and gold, their debt is low, and they are two of the top 4 silver producers. They're a safe, sensible choice to profit from silver. Wheaton have an efficient business model and the most stable dividend, so they are also good, although their valuation is a bit steep. I'm not sure about First Majestic. I like their ambition and where they are heading to, but they require a further in-depth analysis in my opinion, and I would avoid them for now. They definitely look more speculative than the rest of the companies, but if it works out for them, you can make a decent profit. Finally, I would avoid Fortuna and Glencore. I don't like Glencore's debt and tiny free cash flow, and I don't like Fortuna's negative cash flow and lack of dividend as well. If you don't want to buy silver miners, then you can simply buy physical silver from your local bullion bank, although you will probably have to pay a premium on that, a rather large one right now actually. An alternative is buying the Sprott Physical Silver Trust or the iShares Silver Trust, both of which hold physical silver, although the iShares Silver Trust has slightly lower fees. Other ETFs that you can look at are silver miner ETFs, like the iShares MSCI Global Silver Miners ETF or the Global X Silver Miners ETF. Like I mentioned earlier, copper is another metal to watch, and you can check my video here for further analysis. If you enjoyed this video, please like, comment, share and subscribe to help grow the channel. Thank you for watching, and I will see you in the next video.